Today we're gonna talk about a lot of different things. First, a little bit of the market update, even though it's not so fun to talk about these days, and then we move over to the fund update. Well, this is some sort of overview of where we are today. We get constantly fed by negative news on a daily basis, and basically every day is a new record in bad news at the stock market. Hiked rates, increased inflation, plunging housing markets, stock market is down, war, energy crisis, recession, etc., etc. So this is not so much fun these days, and basically today it's very, very macro driven, the market, and not so much of the fundamentals that maybe we have seen earlier this year. So everything is sold off in terms of real estate that are in the eye of this storm currently. It has to do with, of course, hiked interest rates, inflation as well, but it goes both ways, and also housing markets and recession, potential recession that is highly probable, especially in Europe, but also in the US. So despite this, there are some rays of light, I think, if you look at things a bit long term. So it's a bit short-term pain to gain long-term in a way. I will try to address the three major topics that are on the agenda today. It's inflation and its interest rates, and how it affects real estate, and why I think market is currently a bit overshooting, as always, in downturns and upturns. My message today is, if you are a long-term investor, this might be a good inception point during the second or the third and fourth quarter this year. But it will not be an easy path going forward. It will be some bumps in the way, as we experience at the moment. And obviously for us as active managers, this is good times for us to find long-term stock picks, as we also, I think and hope, have done recently. I will come back to that soon. But first, the ones of you that has been following me for a while now knows that I'm always showing this picture. This is in euros. This is big real estate markets. From the left, it's Asia and Asian Pacific. It's the best market so far this year, down about 5% in euro terms. The next light blue bar is the general market, i.e. all segments and all markets. It's down about 11%. US real estate is down about 12% year to date. It has to do with a very strong dollar, but also that they don't face the same problem as we do here in Europe, for instance. But I have to remind you, last year was the best year ever for US real estate. This continues actually, and some companies, despite that they have been coming down about 12%, they start they still look a little bit pricey depending on the economical development we have ahead of us. The dark blue bar is the general real estate index. It's down about 15%, and the dotted line here is SKAGEN M2. Is down about 16%. This is by Friday, I should say. And then we have had basically 3 days in red since then. So every bar here is down even further from when this was made. Europe has plunged about 39% this year to date. And of course, Scandinavia, that had also a very strong year last year, is down over 50%. And again, I remind you, these numbers are a little bit too positive than they are today. So everything is down a little bit more. Here, I think it's a very good occasion to talk about diversification. I've earlier said that we will probably never be on the total right side of this, nor on the left side. Since we are a global portfolio, we don't play different markets, we play companies. And I think over time, this is a good strategy, and despite this harsh marketplace that we see today, we stand with our philosophy and invest in those companies diversified as we do. So how far are we in this crisis? Well, again, the red lines here are today, and they are further down that you can see on this slide because this was also made on Friday. So we're looking here on the right side at the US price to net asset value, and on the right side UK price to net asset value. And here is a comparison with the COVID crisis. That was a deep plunge instantly, but the market came back fairly quickly. You know about this. And the dark gray bar line here with this X on it, it's a great financial crisis. So we're heading there now, both in US, but especially in UK that has other problems than US. So the red lines are further down as we speak. And I refer to this again as probably, I'm not sure, I don't know, nobody knows, but this could be a good inception point during the weeks or months we have in front of us. And I will come back to that pretty soon, why I think like that. And remember also, grand financial crisis was a financial crisis. We don't see that yet in the marketplace. Grand financial crisis was driven by subprime markets in the US, and there were some banks involved, as you all know, financial institutes. We don't have that situation yet in this situation. And on top of that, a lot of real estate companies as of today is more well capitalized and have longer weighted average credit lines than back in the days when it happened. So there are different things back then, but also different things today. We have a war very close to us in Europe, for instance. So what does the market say? What does it price in today? And here I think it's a little bit exaggerated here and there, but just for you to understand this slide, it's the big real estate markets like Australia, Hong Kong, Japan, and the REITs in Japan. It's Singapore REITs, it's UK REITs, US REITs, and Europe real estate, United Kingdom. This is also about 15 days old, so all these bars are actually further down as of today. So the stock market is pricing in even further value declines in assets as when this was made. This also masks some other interesting points, like Europe, for instance. If we insulate Germany, market is, for instance, for the German residential sector, market is pricing in a plunge about 40-45% in asset values as of today on the stock market. I don't believe that. I think it's very exaggerated, and I think it's a lot of other macro factors playing in here. Fear for the winter and gas, fear for war, fear for the euro, fear for very, very many things. If you compare to, if we stay with the German residential, for instance, if you look at the 70s, when we also had an energy crisis, very high interest rates and very high inflation, the German residential market accumulated lost 10%. And that was a time when the market looked worse than today, because today we have a super strong demand still and it's increasing. We have almost guaranteed rents. It's not guaranteed, but they are very, very secure since the state is helping out with the energy bills, both for the companies and the tenants. And there are factors like replacement costs that are basically also working as a cushion, if you like, because the standing assets have its value, but if you build something new, you have to pay at least a double. So there are some hidden values in here, but of course value can go down, but I still think the cash flows in this type of business is very, very solid and high quality. And there are also other opportunities here to find if you look at the investment on long term. You might also recognize this. This is also made by last Friday. So the 26% discount to net asset value on an aggregate global level. here is even further down. I would say close to 30% now, and we are heading into COVID and the grand financial crisis, even on an aggregated global basis. But this masks a lot worse and a lot better, of course, since it's an aggregate global picture. Well, we have talked about different components that are affecting real estate really much. Inflation is one of those, and this is what the experts think. This is not my numbers, and to be honest, nobody knows. So we have to make up our own mind what will happen. But inflation works in both ways. Inflation takes out our purchasing power. It often increases interest rates, like we see as we speak, and it's a very bad thing typically if it's too high. But it also works in a positive way for real estate, and we have been talking about that before as well. And that means the top line is actually adjusted for inflation. So it means that it's a small cushion for a value decrease and cost increases. If we see what the experts think, we know that US, it's more a demand-driven inflation that we're seeing. So, for instance, this summer when the CPI came in better than expected, the market instantly priced in that inflation has peaked and the interest rates will over time come down or stabilize. But that it didn't happen. Rhetoric from the central banks was really harsh and is really harsh still, because they want to tame this inflation, even though it's on the behalf of a recession that we will meet. Probably less of a recession in the US than we will face in Europe. Inflation in Europe is another thing. It's a cost inflation that we're seeing. We know about the energy prices, and it's a very hard thing to think that hiked interest rates will help against this cost inflation. So probably, or what the expert says, is that European central banks will be a little bit less aggressive than the US. Also, you have factors that is probably fading away, like supply chain issues and component bottlenecks in supplies that we have seen for the last couple of years that have also created a lot of inflation. All this, we have seen signs of it's fading away. It's just a matter of how long it will take. But my point here is, and what you should look after, as you probably already understand, but especially within real estate, the day when the inflation is heading downwards, which many people think will be early next year, then the market will start pricing in lower interest rates, and then market will also be more positive to real estate going forward. Nobody knows, and you have to make up your own mind about it, but inflation is not only a bad thing for real estate, and that is also a very big point here. It's not just that you have the inflation adjusted rents over time, but it's a longer term effect, since everything is starting to get very expensive now in terms of new build. Valuation is also following this new constructed elements or houses. So that is also some protection for the valuation, but also it doesn't make the math. If you're a developer and you start to build on speculation, you will not be able to do the math and get a profitable development. So this will also take down the supply a bit, which is very important for real estate. But that's a longer term effect. Also, you have things to in terms of inflation. If you're a company like an office, for instance, you don't have a lot of employees that are hit by the cost inflation for the wages. You don't have that much sensitivity for commodities either, as long as you're not building the office. So there are some components that are positive for real estate with inflation, except from the higher cost in terms of interest rates, and of course the consumption of real estate on the private side, less housing purchases or value decline, less going to the shopping mall, etc., which is a bad thing. If you see in the US and that's the only thing we can look at with a length, there is statistics on how listed real estate has performed during high inflation, moderate inflation, and basically very low inflation like we have had before this period. And looking at the price returns and income returns, which here is dividend, which is a total return concept, of course, that you have in real estate. Best performance you have had over time with high and moderate inflation, which is probably explained by the compensation you have on the cash flows on the inflation, and as a real asset as well, values over time is coming up due to inflation. This is visible, I think, if we look at this picture. This is the US real estate market, the largest marketplace in the world for real estate that are listed. These are the cash flow projections and the cash flow historically that we have seen. If you look at the pandemic year 2020, basically a lot of sub-segments like hotels, shopping malls had to close down overnight, which meant that the cash flow were actually zero cash flow growth. If we look ahead in 2022 and 2023, inflation is coming through now in the cash flows. So this is the projection from the companies themselves, and I wouldn't say it's gonna be like this, because it's always many points of uncertainty, of course, but you have lying rental contracts that are over several years. You have also credit lines that are over many years, so you can with a certain certainty say that this is in line with what it's going to be. Talking about interest rates, and as I said, central banks has changed the rhetorics. Now they're really hawkish and they are prepared to go into recession to tame the inflation. And this is what the experts think. I have no clue if it's right or wrong, but now due to the different inflation components or the different reasons for the inflation, we are in an interest rate hike period this year and probably beginning of next year, and then the uncertainty starts. How high can we go? How much does it hurt the economy, etc., etc. And as I said, look for the point where inflation is coming down, or you can see a trend that it's coming down. So we are in an interest rate hike period, which is always bad for real estate. Here is illustrated by US market again. How does real estate stocks behave during an increase of the interest rates? Well, pretty rational. It's coming down, and it's a hard period during the increase, but after the increase it looks much better, because then the market has started to discount stable or declining interest rates, and here we can see 3, 6, and 12 month compared to S&P 500. So this is a rational picture, and this is what we can expect during the period coming this year, at least, that we will have a lot of upside and downside, but during the interest rate hikes it's always tough with real estate. So over to the fund, and you probably know all this, but for those that are new listeners, we are investing in listed real estate with global exposure, basically in all sub-segments. We are a concentrated portfolio with 33 holdings, and we have a 10-year anniversary this year, and we have delivered not 9.3% in euro, but in NOK. I see that's not changed. In annual return net of fees, and we have a daily liquidity as well. And we like to invest in companies that have a strong cash flow, strong balance sheet, preferably in trend-driven sub-segments like data center towers, but could also be in a more defensive growth business like self-storage, or with quality cash flows and positions like healthcare, for instance, with long leasing contracts, and all companies should be inflation adjusted on the top line. This is the performance we have had as of Friday, I should mention. This is unfortunately a little bit less now. We are down more than 16%, as I said initially, since we have had 3 red days. This is also the time to mention that we recommend a 5-year holding period, since we are at the stock market, and that is probably visible for everyone these days. We have delivered 5.6% in euro terms, up in the right corner, a net of all fees since inception. Okay, what has worked, what has not worked? On the left side, we see the aggregate performance for the fund. The green bar is stock selection, has worked very well. The light blue is allocation, meaning which country we have been allocated to, can be positive or negative, the whole market. And the dark blue bar here is the currency effect. Here we have lost out a lot due to the extreme strong dollar. So unfortunately, we should have had all our money in US due to the currency, and all the money in Asia due to the allocation. But still, we have done some really good stock picking. So we are working on improving this picture as well as we go along. This is the contribution on a company level. On the left side is the positive side. We had a takeout on Switch earlier this year. It was almost 5% in the US. We have Brazilian Logistic, and then we have a group of Pan-Asian companies that has rarely been on this side over the last couple of years. But here again, it's the point of diversification. And they are actually involved in many different subsegments in real estate, data center and office and residential, etc. On the right side, we have the negative side, and here you can find a lot of previous winners like Catena. Catena is a Swedish logistic company. It's a very good company in terms of operations and positions and quality, but it is listed in Sweden, and Sweden has come down over 50% so far this year. Some bigger companies even 70 to 80%. So this is more an allocation effect, I would say, rather than a company-specific effect. Same thing with Self-Storage Group. It's a very strong self-storage operator in Norway. It's a small company, very illiquid, but still it's that type of company we like to hold in times like this. They have record occupancy at the moment. They are growing, they are consolidating, and they are breaking into other new countries like Denmark, for instance. We have another self-storage player on this side is ShoreGuard, which is also extremely strong at the moment with this defensive growth that they have. They have also had inflation adjustment. They had 9% top line year-over-year revenue growth, etc. So these companies are not bad at all, but there are some European effect here or country effect that is coming through. This is the total portfolio. You have seen this before. On the right side, we have this more resilient, stable earners, high quality cash flow, trend-driven subsegments. On the left side, we have this more risky part with office. We have some conglomerates with a little bit of everything, and they are better upside on the left side, but on the other hand, they are more volatile in their earnings and the quality in cash flow. Top 10 position is 45%. That's a number I think was the same last time we had a seminar in April, but the companies have changed. One of the reasons is that we took down Europe after the war breakout in February during the spring, but we also increased some in US and in Asia, which has been very good, of course, due to the performance and the currency effect. So here we have 3 self-storage, and self-storage we like due to the resilience that we have seen in the past in economical downturns. This is a segment driven by life-changing events and downscaling, etc. So we think that's a good position to be in, especially if they have a growing marketplace as all these have. Logistics is also 3, and we have a couple of diversified, a little bit of everything, including some small parts of infrastructure, solar panels, and we also have some hotels here. You can also see, if you have looked at this before, that we have increased US, and I remind you of the switch takeout, which was almost 5%. So you can see that we have increased US. We have decreased Europe, but it's also a weighting issue due to bad and good performance, of course, including in this. We are an active portfolio, so we will never just be in one market or in one sub-segment. This is about diversification and finding the right companies. We have a lot of focus on the balance sheet. We always talk about this, but it's important. It's always important, but it's more important now than ever, I would say. And I sleep fairly well with the balance sheet of our portfolio. We have a 7.4 times interest coverage ratio. We have 5.6 average loan maturity, meaning that we have some that has to refinance a little bit earlier, but a lot of companies also refinance further down the road than 5.6 years, which is an asset in these days when interest rates are hiked very, very quickly. LTV is it's a metric that is commonly used, but it's also a dangerous measure because the value part here is a variable and it might change quickly. So LTV can come up quickly as well if the values are eroded. And another important thing I want to highlight, we have a very large portion of the portfolio in fixed or hedged interest rate levels. So that means that they are insulated from the interest rate hikes that we see now, not fully, of course, but anyway, it's a majority of the companies that we hold that have a very good debt structure, which is important for us. And a better measure to look at debt is net gearing, and then we have a 78%. This is a capital intensive asset class, real estate, so we are pretty comfortable with this picture that you're seeing now. If you look at valuation, we are still below in terms of book value, cash flow, and earnings yield, but the only thing we miss out on here is the dividend yield. Since we are not heading for maximum dividend, we are rather investing in companies that are generating high cash flow and reinvest it in good projects with high return on investment. That's part of our philosophy and that's part of our strategy. So it's perfectly right for us to have a lower dividend yield than the benchmark. So a couple of new holdings in the fund, and I said before initially, this might be a good inception point for the fund, but also for companies. We find a lot of cheap companies now, and I think these are tomorrow's winner. Maybe not tomorrow, but down the road. One of these is a self-storage name, Big Yellow. It's trading at least 10% discount to NAV, and then over the last 10 years, it has been trading at 25% premium to NAV. It's state-of-the-art in the UK. So pretty comfortable with that, and we think it has an upside of 40 to 50% from today's level. On the far right side, we see Unite Students. It's a new pure holding for us or sub-segment. We have been into this segment before through conglomerates, but this is a pure student housing company, also based in UK. Also trading at a huge discount to NAV as of today. This is a very sought after asset class or sub-segment from huge institutions and sovereign wealth funds due to its resiliency, especially in economical downturns, since many start to study or start higher education if they get unemployed, etc. But also the attraction for UK now with the low living costs and they have a very interesting demographics for this kind of assets. To dig down a little bit in the middle name here is Independence Realty Trust, and that's something we have looked at for a long time now. It's multifamily housing in the US. We see about 50% upside on this, is trading also at a huge discount of NAV. Why are we interested in this? Well, the equation is easy here. We have seen rocketing house prices in the US, but they have been driven by undersupplied markets. We have seen a lot of move arounds in the different states in the US, creating demand in different hubs. But we have entered rental housing for many years now, but through manufacturing housing, which also is a rental housing part, but is different from multi-family housing. Of course, this starts to get pretty expensive on the mortgage payments for the Americans. They pay now 6.2%, which is pretty heavy. And we think we have seen the housing market, the buying market has come down. So we think that in terms of attracting more the affordable segments, we have taken a position in Independence Realty Trust. It's a $3.6 billion market cap name with assets of about $8 million. And they have also a strong balance sheet, which is important going down the road now. Why do we like this? Well, it has attractive Sunbelt exposure, and Sunbelt attracts a lot of people in the US. Here we have seen the largest growth of the population over the past decade. And we know that 62% now lives in the Sunbelt as of today, due to lower cost of living, better tax policy, etc. So we know that population growth and employment growth is key drivers for multifamily residential demand. So this is one component why we like this. The second component is that they are addressing the mid-market or the B-class segment, which is actually capturing tenants from both the higher segments, which is A, when times get worse, but also attracting people from category C, which climbing up the ladder in terms of income, or we're doing careers or expanding the family, etc. So this has proven to be a resilient segment to be in and attract basically more people than being in just A or C. A, by the way, is the segment you should be in when you have a very strong economical development. So the third thing why we like this is that they merged with, or they merged with another company last year. So they have about 35,000 units. It's still a small company, but 20,000 of these are units that they can refurbish. And they refurbish this with a target of 20% return on investment capital, which they have succeeded. This year, they have all the refurbishment they have made. They have had about 34% return on investment on their refurbishment. So this is the valued add initiative. And this is fully financed by their internal free cash flow, which is, of course, a good thing. They can always gas a brake on the renovation pace that they have. So this leads us to the question that you might have now. Will not rents come down in the US? Probably they will come down a bit. You have also an inflation component, but the good thing here is that Independence is already way below market rents, so they have a small cushion there. They're actually trading, they have rents that are about 18% lower than the market as of today. This is a small company among big sharks among them that want to consolidate the market. This is also a high sought after asset subsegment in real estate. So we think this is a potential take at target among the big ones or private equity. So just to summarize, to open up for some questions, we are currently in the eye of the storm, but and we can expect further volatility, especially during the next couple of months. But a lot is already priced in, as I showed, in terms of asset value decline, in terms of many things. And we have a lot of interest rate hikes priced in, a lot of inflation, etc. So everyone has to think about, is this a good or bad time to enter the market? we find companies today that we think over time will be good investments. And just to remind you what happened in July when they talked about peak inflation in the US, market just turned and got crazy for a while until it didn't anymore. So the market will actually react very, very quickly. And I don't know when that time comes, but it can, of course, come new bad news every day here, as we have experienced over the last week or so. But if you have a long-term horizon, I think it could be worth of thinking of investing in real estate now. And we have a good history of good performance after rate hike cycles. Overall cash flow is still good and credit is available. Not for everyone, not for the biggest deals, and not for the highest leverage companies, but there are credit available out there. We see that every day, but it's a little bit more expensive. Inflation protective narrative still holds, and we have seen that in history, and it will be like that going forward as well. I want to remind you that the inflation the inflation adjustment in rents, typically in Sweden, they are done at the year end for the year before. So you have a mismatch between the inflation protection, the interest rate hikes, but you always also have fixed rates here. So you have some sort of mismatch, but you get compensation for the inflation on top line in real estate that we have seen historically. Transaction likely to remain on high levels, which will help valuations. This will not be the industry companies probably, because they will have a hard time to finance at decent levels. This is private equity, this is sovereign wealth funds and insurance company that will pick up super cheap companies now on the stock market, but also on the private side. So we have also gone through that SKAGEN M2 likes companies with strong balance sheet and cash flow generation, and we try to find companies or sub-segments with relative strong pricing power, which we find in self-storage, for instance, or in some other segments, towers. And active management provides opportunities in times like this. Even though it feels horrible to sit here in front of you when everything is red, there are good opportunities out there as well. One should never forget about that. Thank you, and I apologize for taking a little bit too long time of your time.